Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome viewers to another episode of Pathways to Prosperity. And tonight I want to discuss with our special guest a very, very important thing. Oftentimes we get complaints a lot of the time from our clients where they say to us, banks don't want to lend small businesses money. They don't want to help startup businesses. And we feel as bankers that this is as a result of clients not understanding what we would call the funding continuum. Different businesses at different phases of their life cycle would require different funding. So today we have a specialist in this arena, Ridwaan Kajee, Senior Analyst at 27 Investment Managers, where we're going to unpack the different funding programs or different funding constructs that a business will require at its different stages, and hopefully you'll find value in this. Ridwaan, assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum salam. Ameen, jazakallah for having me.
Thanks for coming through. So maybe just to start off the conversation, do you think that complaint or that assertion is something that you guys within an asset manager side of things, do you hear this as well, that banks don't want to help startups?
All investors and lenders sort of look at businesses that need capital from a risk and return perspective. Obviously, our background, my background is not necessarily from the banking side, but we have a lot of experience with typically how banks view businesses and opportunities that require funding. And a bank has things like, which you would know, things like capital adequacy requirements, etc., that needs to manage when it looks at certain funding opportunities. I think that's where the opportunity sort of presents itself for the equity side of things, or asset managers, or investment managers rather, and that comprises not just guys that invest, in listed markets, but private markets as well, whether it's venture capital, private equity. There's more of an appetite, obviously, to fund businesses that are startups. It does differ depending on which private equity firm you chat to, what their appetite is and what the return requirement is. But naturally, a startup will have a higher risk profile. So it is understandable that a bank wouldn't necessarily have the appetite to provide funding to that. But that's where the opportunity lies for other investors or other pools of investors rather.
Let's go deeper into the conversation. Now, you mentioned this term called startup, right? So in my understanding as a banker, a business would be at different stages. A startup would be you're just starting up, you don't have clients, you've just maybe proved a concept, or you've just developed your product or obtained an IP or something, or you have this great idea that you think you're going to be the next Uber or something. As you grow, you'd become a small or medium-sized enterprise. You then go into a commercial enterprise. You'd grow into a multinational corporation where you're now spreading at different geographies. And then you can move all the way through into what we would call a listed multinational corporation. Now, you've spoken about the startups, and we know that it can reach all the way to a listed. Let's give our viewers what that funding continuum looks like. So when I'm at startup, who do I go to look for money? Because now I've got this great idea, the bank doesn't want to give me money. The PE firm is going to tell me, listen, you're too small, I'm only going to invest that. My minimum ticket size is R1 billion and I want 25% equity and I want to hit this threshold and whatever. And it becomes complicated. So let's dumb it down in the easiest way. I'm a startup, who do I go to look for money?
Sure. So I think as a startup, assuming that your business is now really in the ideation phase, so you sort of have an idea, you believe in your heart, as all entrepreneurs do, that this is going to be the next big thing. But you need money, obviously, to sort of fund yourself, fund certain costs around research and development, depending on what the product is. Assuming it's a tech-based startup that's very disruptive. Typically, there's a concept called bootstrapping, and that's where you, as the entrepreneur, actually have to put in some of your own capital. As that sort
so
of
the technical term, bootstrapping.
Correct.
Right.
Correct. Bootstrapping is effectively just you bootstrapping and funding your own business initially. As that moves into sort of creating, prototypes. As you sort of expand your market analysis, you start testing your product and your idea with the market. Typically, what we see in the startup phase is that you then start to approach family members, high net
angels,
worth, angel investors,
Right.
which are wealthy individuals that really are sort of have experience perhaps in the industry that you're playing in, or that your idea sort of fits. They really get it. They believe in sort of what you've told them about the potential for your project, and you can raise capital from those sources as well.
So first two phases, bootstrapping. I'm putting in my own money and I'm bootstrapping my way through it.
Yes.
Phase two is, okay, I've reached a certain stage, but I need to now get into market and start generating revenue. So typically at that point in time, you'd go to a seed fund, an angel fund, family, friends, and typically they have this thing around them called angel investors. They're like your secret helpers that come through. Okay, got it. Now I'm in market, I'm starting to generate revenue.
Correct. So once you're revenue generating, remember you potentially and very likely not yet profitable,
Right.
Because there's still obviously, you sort of have some traction with the market. You don't yet have a massive client base. You've probably just signed on your first big customer, but there are still costs involved with scaling your operations. The next sort of funding round or funding or part of the continuum that you'd look at are VC companies. So the term VC really refers to an organization or a firm that has a mandate, that has capital and an appetite to invest in companies that are at that stage. Now, typically VCs invest at some points pre-revenue. It obviously depends on what stage your business is in. As you just mentioned for the viewers, in many instances, pre-revenue would imply that the funding sources you have are generally limited to individuals or angel investors, but there are certain VC firms that have mandates that can provide you capital. But a lot of the time, these firms really want you to be revenue generating. Even if you're not profitable as yet, you can approach these firms for capital to really get you to that growth path that is really the next phase post revenue generation.
Now, at this stage, I've heard many people complain about this phase of the business. They don't want to give up equity. You've bootstrapped your way through. You've got your mother and your father there as angel investors, or your brothers or extended family members or best friends. And now it seems as though I'm continuously diluting my equity. What would you say to a person who's in the shoes to encourage them or getting them over that psychological hurdle to say it's okay to dilute if you've got a big VC firm behind you, or it may not be the biggest VC firm, but a good reputable VC firm that's there giving you the support you need?
I mean, it's a very important question. I think it's not just relevant for just startups. It's actually any private business out there that is looking to raise capital. Naturally, the capital sources that they have available to them is credit or lending from a bank, and we'll get into obviously the types of funding that are available from a lending perspective, whether senior or mezzanine. But from an equity perspective, I think it's important for an entrepreneur or business owner, when you're looking at that next phase of growth and you're looking at whether it's a VC firm or private equity fund that is looking to give you money, it's very important to make the distinction between equity and value. And what we mean by that is that by virtue of you giving up, say, 20% of equity or 25% or whatever percentage the private equity or VC firm is negotiating for, you've got to sort of consider what is the long-term value that is possibly created by virtue of this partnership that I'm getting into with this counterparty. A lot of the time, these firms do bring certain value to your business as shareholders. You don't want to just bring in a silent shareholder unless that's a worst-case scenario. You want to bring in a partner or shareholder that really has a track record of backing other businesses in the market that have proven their value add. Whether it's, and that can be broad, right? That can be helping you sort of bring stability to your operations. It's enhancing your governance so that it really positions your business for the next phase of growth. It's things like opening up new markets, introducing you or your business to their networks, which you don't necessarily have access to, because it's really a big world out there. So you've got to rely on these partnerships, and what that allows is that by you giving up 20% of equity today, even though that equity of yours is reduced, the long-term value that is potentially created is a lot more than you would have been able to achieve on your own. And that's the important distinction that I would probably say entrepreneurs that are looking to raise capital should consider when they're engaging, VC firms, partners, new equity investors.
Okay, now you got to wear my hat, right? Now you have to put the banker hat on. So up to this point in time, I've gone from startup and idea phase, I've bootstrapped, I've now got product, I've got some angel investors in friends and family, I'm now either pre or post revenue, and I've got myself into market with a VC or PE firm. I haven't heard a bank anywhere, right? What does the bank do then? For the benefit of our viewers, what does the bank actually fund then?
So a lot of the time, when you think about it, it really depends on the needs of the business, right? As your business sort of scales, and take, a typical sort of manufacturing business that produces widgets, there's always CapEx requirements that are needed. There's a new sort of warehouse that may be needed from an expansion perspective. That capital can be brought by your PE fund. Obviously, that will come at potentially more equity that you'll have to give away. But a bank in that instance would be a better solution because banks typically look for security, as you would know. So you'll need to consider sort of what is the available assets or security that I'm able to offer to the bank, and does that sort of fit their risk profile? Now, that's the one consideration. The other is obviously your cash flows.
Right.
A lot of the time, a bank would, as you would know, in looking at whether a business is fundable or lendable, rather, they would look at those two main things.
Cash flows.
Even though the security might be there, you might have, a holiday home that you're able to, or you're willing to provide as security. If the cash flow profile of your business is not able to service that debt, a bank is not a real estate agent. They're not in the game of taking properties and trying to sell it in the market. Yes, it helps your case with the bank, but cash flows are very important. But so if you're able to sort of align those two in your business with those requirements of the bank, and it really takes engagement with the bank, obviously, to talk through your business, to help them understand your cash flow profile, to help them understand sort of where risks are, where the potential opportunity is. But that's where, you can actually get the bank involved. One, the cost of funding is actually cheaper. You don't have to give away any equity. You can actually bring in bank funding to help fund the next stage of growth and still retain equity. But it's important to obviously manage their requirements as well.
Ridwaan, you touched on a very important thing. I think the biggest thing that we would look for is the cash flow servicing. Can you actually service the loan with cash flow? And if you allow me, I think one of the things that many people actually forget, they know it's probably there somewhere in file 13 of their subconscious, but banking 101 is basically we take other people's money and we take that money and we lend it out to borrowers. And many people always say, banks are too conservative and all of these things that we've been speaking about, but in truth, we're custodians of somebody's deposit. And if I were to ask you as a depositor, listen, can I take your 100 billion rand and just do some VC stuff with it? You're going to say, no, I want security and I want stable returns and I want capital preservation and that's what people forget, is that as banks, we actually have to be conservative because we're custodians of people's deposits. Okay, Ridwaan, so we've chatted around all of these things. The one last thing that I want to maybe just close off. Everybody looks at this big dream of the JSE or the NASDAQ or the New York Stock Exchange, and everybody feels that, I want to grow my business to the next listed entity. But I know one of our senior executives of the bank always said that, listen, if you don't need to raise capital, don't go list. What's your view on whether business, we've got, alhamdulillah, in our community today, we've got many Muslim family-owned multinational corporations that are as big as listed entities or even bigger, but they remain within the unlisted environment. What's your advice from an investment management perspective? When should a business look at exploring whether they should list or not?
I think, what we're seeing, the decision to list is obviously a very complex one. Your non-exec is absolutely correct that, where there's a need for capital at that level of scale, once you've reached or become a very large private business, if there's a large need for capital whether it's for growth or you as the existing owners want to take some capital off the table, listing is absolutely a consideration.
Right.
However, listing comes with a lot of requirements in terms
Yep.
of JSE listing requirements, the requirement to comply with King from a governance perspective. You now no longer necessarily have the control of your business that you would like. Your business would have a lot more processes, governance checks in place that perhaps make you a lot less agile. I think I don't want to sort of put myself in a corner and say, I would advise businesses not to list. I think growing the number of listed companies within our country is a good thing for the broader economy. If you think about where most of the capital in our country actually sits, being retirement funds that trust asset managers with capital to invest, a lot of those retirement funds have certain restrictions and have to actually invest most of their money on listed markets. So it's actually not a good thing for, and we're seeing this with the JSE over the last sort of 2 or 3 decades, that the number of listed companies are coming down. It's not a good thing, whether that is because it reduces the pool of investable listed opportunities from an equity perspective. But coming back to your question directly, I think it's a very difficult consideration. It depends on the circumstances of that business in particular. As I said, it might be an opportunity to take some capital off the table at perhaps rates that are more favorable than what perhaps a private equity fund is willing to buy in at. Obviously, at that level of scale, if you're listing a company at, say, a couple of billion rands, the alternative is to actually sell some equity, say, to a private equity firm. But there's very few players then it can actually fund a 2 or 3 billion rand check to buy into a business, and hence listing becomes the only option. So it's really around those aspects. It is something that's quite dynamic. It's fluid. It depends on the circumstances and sort of what the plan is for the future around retaining control, access to future liquidity, and that sort of thing.
Ridwaan, Jazakallah Khair. Viewers, we've been having a beautiful discussion. I think the takeaway from this is, as a business owner, you need to know where you are in the business cycle, what phase your business is in, and alongside that, putting in place the correct capital structure of your business and the correct funding structure of your business. Capital structure meaning, do you need bootstrapping? Do you need angels? Do you need VCPE, or do you go and list? And your funding structure is, do you put in a whole host of different senior or mezzanine structures, which is lending from the bank with a much more conservative risk appetite. So please let us know if you're enjoying this, and we'll deepen the discussions on that and more advisory services specifically around this. But until next time, Assalamu alaikum wa rahmatullahi wa barakatuh.